Let's just find out, you've been reducing your equity exposure, I understand. So tell me, how much have you reduced it by?
Well, we did it in two moves. We used some of the recent rebound also to make another move. So we are now significantly underweight against our own benchmark, which is the what we call the strategic or long-term allocation, which incidentally is also lower than many comparable global diversified funds, because we do see that we are living in a world where, growth in the major developed markets is just going to be mediocre at best compared to what we've seen in the past.
Is that the real reason why we're seeing this sell-off? Because, if we look at the U.S. economy, actually nothing, albeit the downgrade, but nothing has materially changed within it. In Europe, it does seem as though nobody believes anything a Eurozone official says. So, but these things have been in the mix for a while. Why now?
Well, what has happened now is that I was referring earlier to the broader long-term framework or the structural framework. What has happened in recent years is that we've had a cyclical recovery, which was, for a time at least, quite positively surprising. It was stronger than expected, but it has come to a stall with certain events, including the Japanese earthquake in March, and then the failure, basically, of both the political systems of Europe and of the United States to come up with credible long-term plans to say, look, we're going to do something short-term to boost the economies, but we're on top of our debt problems with long-term credible plans. That's not there, and I think the S&P, the ECB's policies very recently, and also the S&P downgrade helped accentuate these factors, which at this point, at that point, the market lost confidence. And when you lose confidence, it's very hard to stop this cycle of self-fulfilling, potentially self-fulfilling negative prophecy. So that's what happened, we believe.
Yeah, well, with that in mind, of self-fulfilling prophecies, etc., what is the equity market in particular pricing in right now, then?
Well, the equity market, and also if you look at the bond market, so markets as a whole at the moment are pricing in, at the very least, a recession, perhaps even something worse. I'm not saying that this is our scenario. We still think that, the economy, we see little evidence that there is a recession coming, but it's certainly indicated by markets that this is the major fear right now.
Yeah, let's just also take a look at what you see happening in the short term. We saw the sell-off and we saw that recovery in the session. We've got another down leg. Does it continue, or do we see another uplift and just see continued volatility out there?
Well, I think the risks right now are skewed in the short term. There will be some action by policymakers. We already saw a first decision by the Federal Reserve. And I suspect there will be more from the G7 and maybe the G20 and maybe something out of Europe, or very likely something out of Europe. And these measures, given that we've had a very, very big breakdown in many major markets, they will help stabilize things for a while at least. But I think over the next weeks and months, the probability is higher that we're going to see new lows before we can find a final bottom.